Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. I don't know pretty much anyone that doesn't have a home office at this point. It's just become the norm. When they say going to the office, we think going to the guest room, going to the extra spare bedroom, going to, the den, going into the kitchen, right? I have to go to the office. The office is wherever your laptop is nowadays, even your iPad or your iPhone. What I want to talk about with you today is how you can get an advantage tax-wise for having a home office and how to do it in the most legit way that cannot be argued by the IRS. So how to make sure you're doing it legitimately, legally, and you know the rules around it so that you can play within those rules. So when we talk about a home office, the first thing to remember is that you need to qualify the home office. So when I ask folks, do you have an area of your home that you use for business? Usually the response I get is, yeah, the kitchen island, the dining room table, the couch, that chair over there in the corner. I work from my bed. And unfortunately, none of that stuff works. One of the qualifications for your home office is that your home office needs to be exclusively used for business. And they're pretty strict about this, by the way. Exclusively used for business. What does that mean? It means that you cannot have it serve another purpose. So for those who don't know, my home office, I actually have two offices technically in my house, but my quote unquote podcast studio now is in my guest bedroom. And the area that I use right here recording podcasts, I'm sitting right next to a bed, an extra chair, a dresser. I even have like one of those like under desk bikes, like the ellipticals. I'm just looking around the room. I have my closet. There's so much stuff in here. It's just the spare bedroom, right? It's where we dump a lot of stuff. And what you have to remember is that the area I can deduct is only the area that is used exclusively for business. So I'm just in the corner of the room with my desk and my equipment, and it's really tiny. I don't get to deduct the whole room. I only get to deduct the area I use exclusively for business. The other criteria is that it has to be the principal place of business. And what we usually refer to this as is the primary place where you see clients, if you see them in person, or the primary administrative location where you're running things, right? Think of like, well, this is kind of the administrative HQ. This is a major business location. Maybe you accept mail here. That can be part of that qualification as well. So like I mentioned, you can't really take your kitchen, your dining room, your bedroom, because they serve other purposes in your home. They do. You can't say that I don't cook in the kitchen, I only work, right? So it's really hard to argue. I know some of us are in that position, trust me. Never cook, always working, especially in small apartments, but it does not fly with the IRS usually. So we don't try to push it. The other thing to keep in mind is if you have a home office and for any reason it's under scrutiny, you want to make sure that anything that could evidence another purpose is not clearly visible. It has to be exclusively used for business. So here's how strict they could be, right? I just mentioned I have an under the desk elliptical under my desk right now. If the IRS were to come in here, because I do only use this for office for working, but I got to move my legs once in a while. And this is not a bad idea to have something under the desk. But here's the thing. If the IRS came in, they can be so strict to say, nope, it's also doubling as a gym, can't deduct it, right? I know you're probably going, what? Yeah, they can be like that. So what I do is I just make sure that there's a very clear distinction of this is the business space and then anything else is to the side. So those are the criteria to even have the home office deduction. So if you're with me so far and you're like, yep, I got a home office that qualifies, let's keep going. And if you don't, let's come up with ways that you could shift that and that you could qualify or that you could argue why it is the case. So if you have that qualification, now the way you deduct your home office will vary based on the type of business you have. There's really two major approaches here. And we're going to go through each one, but let's go through the first one. If you're a sole proprietor or you're a single member LLC or you're a partnership, basically, if you're not a W-2 employee in your business, this is the method you use. So if you are not a W-2 employee and you are self-employed, then you take the home office deduction the way it's traditionally done. And that is done every year on your tax return. Your accountant will do some fancy math and fill out this form for the home office deduction, and they will do all these calculations for you, and you'll get that benefit on your tax return at that time. Meaning, if you get a deduction for your home office, there is no money being exchanged during the year. You're just going to get your tax liability reduced, or it may increase your refund at the time that you file your tax return. So really, you find out once a year what that effect will be, and you get that benefit. Now, you wouldn't have to do anything during the year to get that benefit, but you will have to have the square footage of your space used for business at a minimum. That is the one thing you always need, is get out your tape measure and measure the area used for business. Bonus points, by the way, if you take a picture, especially, by the way, if you're going to move. I'll talk about that a little later in the episode. But if you're going to be, changing locations, or you're taking a home office for a period of time and you want to claim it, it's not a bad idea to take a picture of it, just so that you have the evidence for a later date on the square footage, so you could show, yeah, it's about that much square feet. It's reasonable, especially if you're taking a high amount of square footage. So there's really two ways to calculate this home office deduction. So if you're with me, we're talking sole proprietors, LLCs, partnerships. If you're self-employed, we want to do the home office deduction, but there's two ways to do the home office deduction. They're called the simplified method and the actual cost method. The simplified method is exactly what it sounds like. It's straight up $5 per square foot up to 300 square feet, period. So if you have less than 300 square feet, then we're talking simply $5 per square foot you could take as a simplified home office deduction. Easy. Now, all you need in order to do that is the square footage. That's it, the square footage of the space. And you can calculate that. A lot of people opt for that method because it requires less preparation, less math, less responsibility. But as we always know with this podcast and with everything we do, with great tax savings comes great responsibility. So what we traditionally opt for with clients is to use the other method, which is the actual cost method. It's usually better. It usually gets you better tax savings, especially if the area in your home is bigger that you're using for your business, or if you live in a region with a higher cost of living. The sweet spot for me is anyone with a Manhattan apartment who runs a business out of half their apartment is like golden. We're talking like, a $5,000 a month rent, and then like 50% of that would be magical, right? But for those of you who are living in a high cost of living area or have a big area used exclusively for business, this is the method you probably want to go with. And it works by taking all of the costs to live in your home. So we're talking rent, we're talking mortgage interest. Note, not the principal, just the interest. So break that out. So mortgage interest, the rent, insurance, security, cleaning, landscaping, repairs, maintenance, internet, utilities, garbage disposal, anything that you would be spending to own and maintain your home, basically, to live in and maintain your home. And then what you do is you take that square footage of your home office that qualifies, right? Divide that by the total square footage of your overall home. You're going to get a proportion. You're going to get a percentage. So if, for example, I live in a 3,000 square foot home and I have a 300 square foot office, then we're looking at 10% of the home, which means that 10% of all of those costs I just listed, mortgage interest, rent, insurance, utilities, 10% of all that is deductible. Isn't that cool? So that can actually be way more lucrative. Again, especially if the costs are high or the area is high, right? This is simple math. What you want to do is keep a log, keep track of all these expenses, and make sure that by the end of the year, you have all those totaled up, because what's going to happen is your accountant's going to do that fancy math on that sheet on the second method and figure out how much of a deduction you get from using your actual costs. Now we're going to go through, what do you do when you're an employee of your business? So we just went through, okay, if you're self-employed, you do the home office deduction, you do simplified or actual cost. Easy peasy, because your accountant's going to do most of the work in calculating it. All you have to give them is the square footage and the cost. Now let's talk about corporations, S Corp, C Corps. If your tax is an S Corp or a C Corp and you're an employee of your business, this actually opens up a whole new method. Ideally, you would use what's called an accountable plan. And you've heard me talk about this before on the podcast. The way it works mechanically for a home office is you'd use the same method. I'm not going to rehash it. The actual cost method we just went through, right? The percentage of all those costs. You're going to use that same method. The difference is that you're going to get a check, a reimbursement check every single month for those costs. So what that means is regulating cash flow. That means that you're going to see cash money in the bank, tax-free transfer of money every single month, because you're going to be able to reimburse your home office use every single month. Technically, you reimburse within 60 days or so of incurring the expenses, but I tell my clients to do this monthly because it's just a good cadence and routine to follow. So when we're talking about the accountable plan, you would document the actual cost spent, documenting that proportion of the home used as a home office, and you would actually move the money. You would take that, for example, the 10% we used in our example. You're going to take that 10% of those costs and you're actually going to pay yourself. You're actually going to move the money from your business account to your personal account. Now, you got to make sure that you're talking to your bookkeeper about this. They understand how you're doing this because it looks like a distribution. It's actually a reimbursement. You got to make sure that the accounting for it is properly treated, so you're getting that deduction properly. But this is a rent expense to your business and yet a tax-free transfer of money to you, because it's not income to you. This is just the home office deduction realized in the form of actual money being moved. The best part of this is that you get the deduction, but you also get actual cash moved to you. The other good part of using the accountable plan, which again is available only if you're an employee of your business. And side note, I would not, if you're an LLC, sole proprietor, and you're like, oh, cool, I'll make myself an employee of the business right now. No, please don't do that. You would only be an employee of your business if you're taxed as a corporation. Remember that. So you don't put yourself on payroll if you are a sole proprietor or a single member LLC. You want to make sure that you are going about this the right way. So keep that in mind. Now, the other advantage of the accountable plan is that when you're doing these reimbursements for the home office, you're also not, you're not going to be putting this on a home office deduction sheet on your personal return. These are straight up expenses on your profit and loss. Why that's a good thing is because the home office deduction, now it has a stigma. So if any of you are wondering, like, oh, I heard the home office deduction triggers an audit. It did in 1992 when that was a thing that like nobody did, right? If you're claiming a home office, when not all households even had a computer, then it was much harder to argue that you could work from home and take advantage of this. So keep that in mind, that's kind of an old fable. It does not trigger an audit. However, it is nice to sort of bury, not hiding for the sake of hiding, but like bury these expenses in your P&L as opposed to putting them on a bold-faced separate form and calling attention to it for the reimbursement. So it looks the same as though you're paying rent to any landlord, which I like. So it's less likely to get scrutinized in an audit. These are all legit strategies, but to the extent that we can make it less likely to be hassled by questions, let's take that opportunity. Oh, and it also could lower prep fees. People don't think about this. When you pay your accountant, they might charge you by form. Some accountants charge you, some tax preparers charge you by form. And if you're reducing the number of forms by not having to file the home office deduction and doing the reimbursements instead, that could actually save you money. People don't realize that. So that's another little like side effect. Now, what if you move during the year? What if you have two different home offices? What if, like, there are so many questions that come along with this, right? So I'll do my best to answer at a high level, but hey, if you have specific questions about the home office deduction for you, definitely jump in the community, definitely hop on our monthly connection calls, because that's a perfect opportunity to dive deeper and get you more details on your situation. But in general, if you move during the year, just keep in mind, You're going to have to separately do the calculations for each home or each office with the square footage and the total amount of the home. You're really just treating it the same way. And you just have to make sure that you've got all the actual costs aligned properly. So if you went from owning a home to renting a home, then make sure that for the months you are renting, you're taking your proportion of the rent. And for the months that you owned, you're looking at the mortgage interest, right? And you're just collecting all that information. And if you take the home office deduction in a traditional way, then just make sure you have all that information available for your accountant to do those calculations with you. Really, it's just about keeping track of all this stuff, keeping track of what you're spending, and being able to deduct it to the best extent possible for your type of business. Now, if you want more information about figuring this all out and need some help implementing, we got you. All of this is part of what we do in our tax strategy service, and we will be happy to help you. All right. We will see you on the next episode. Hey, wouldn't it be cool if you could chat with me and our guests about this episode? Well, guess what? You can. Join the Keep What You Earn community now using the link below in the show notes. You can post your questions, chat with fellow business owners, and the best part, it's totally free. Oh, and by the way, it's not a Facebook group. That's right, no noisy notifications or distractions. Just what you need to get the full experience from listening to this podcast and maximizing your value. Meet us over there after the episode to get exclusive content and access to me and our guests for your questions. We'll see you over there. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.